You brought along a chart that illustrates earnings revisions that were positive for the fourth quarter. That's the current quarter at the beginning of this year from January till October 1st. And then the S&P rallied more than 9% coincident with that. But then earnings revisions for this quarter went negative and stocks fell almost 6% between then and now. So, I mean, it seems as if corporate fundamentals actually matter quite a bit. Is it just as simple as that, Nick?
It is, and it's a good reminder that even though we talk a lot about things like interest rates and Fed policy and what's going on with trade and tariffs in China, they filter through to fundamentals really importantly, and we saw that with the revisions going to the upside and stocks working great, and the minute the global economy began to roll over, earnings revisions began to roll over, and that's the period we're in now.
And so does it appear to you anyway that this downward revision phase is going to last into next year? I guess I'm trying to scale exactly how much potential risk there is here because, you know, really one of the clear observations from 2018 is that corporate earnings growth grew 20%, but the stock market is just barely above the flat line.
Yeah, that's exactly right. You know, I think the environment we're in right now is we had 25% earnings growth for Q1, Q2, and Q3 of this year. Q4 is going to be more like 13 to 14%, and next year is going to be more like 5 to 6%, even though analysts still expect 8 to 9%. So the worry that we have is that you're going to see continued earnings revisions to the downside, not just for Q4, but for 2019 as a whole, and that gives the market some pause about valuation and future earnings growth and creates the volatility that we've seen and should continue to see.